Men's College, what we now call Claremont McKenna, second graduating class in 1949. He received a BA with honors in economics from CMC, a JD from UC Berkeley, and a Master's of Law and Taxation from NYU. One of his most impressive accomplishments includes selling his investment advisory firm to U.S. Trust Company in 1998, and then becoming its managing director. At age 89, Peter Maier continues to work almost full-time as chairman of Private Wealth Partners, a wealth management firm located near his residence in Belvedere, California. And he happens to be our grandfather. I would like to share a quick anecdote from my grandpa that I find relevant to this Ath Talk. When Peter was 11 years old, he escaped World War II-ridden Europe and immigrated to the United States. When he arrived in November, he was surprised to see that many Americans were in a jovial mood, celebrating amongst the streets in a display that could only be described as thankful. To my grandfather, a German resident who was unaware of American holidays, he had believed that America was celebrating his arrival to the country of hopes and dreams. In reality, it was only Thanksgiving. Yet, while the entire American population may not have been celebrating his arrival to the United States, the 60 or so of us in this room today are most certainly here to learn and, in some ways, celebrate my grandfather's extensive knowledge.
Peter was professor of law at the UC Berkeley Hastings College from 1967 to 1995. He is active in various charitable organizations, serving as chairman of the Fromm Institute for Lifelong Learning at the University of San Francisco and as president of the John B. Huntington Foundation. In addition, he serves as a trustee of the Alfred and Hannah Fromm Fund, the University of San Francisco, and the Osher Center for Integrative Medicine at the University of California Medical Center, San Francisco. I can ramble on and on about my grandfather's wealth of experience in his field, but I ought to turn it over to the professional himself. Grandpa, it's a privilege to have you at our college today, and we are so incredibly proud to call you our grandfather, not only because what you have accomplished in your professional career, but also because of the amazing person that we know you are. With that said, please welcome Peter Maier to the Ath.
Well, I've given a lot of speeches in my life before, but I've never been introduced by my grandsons. And I didn't know I did all those things. My topic today is to summarize the new tax law and talk a little bit about some of the mistakes that people make in taxes. This would normally be, I would say, a 12-unit course at CMC, which I'm instructed to cover in about a half an hour. So obviously some of the details are going to not be mentioned. Trying to organize this thing, I actually read the new statute, which, let me say, very few people in the country have read, and that includes all the Democratic senators who never got a copy of it because they weren't going to vote for it anyway. Indeed, this is the most comprehensive tax legislation we've ever had, at least in the last 25 years, and it passed the Senate by 51 votes, which you know is barely sufficient. So I try to organize this in ways that might be of interest to you, and I'm going to talk about it in terms of what changed for the better for the average person, what changed for the worse, and how is business affected. So let me start at the top. There was much to do about the cutting in the rates of tax. It's about 2.5% for individuals, but as you'll see, there are some things they were also taken away. They doubled the standard deduction, which makes it unnecessary for most people to itemize the kind of things you deduct on your tax return, Schedule B, such as medical expenses, charitable contributions, interest on mortgages, and the like. If you do take those deductions and you don't take the standard deduction, most taxpayers in the U.S. will take this large standard deduction and not bother to itemize their expenses. A very important provision which has been downplayed, I think, in the media is the repeal of the compulsory participation in the Affordable Care Act, otherwise known as Obamacare. This has tremendous consequences because it means that most of the people in this room don't have to buy insurance anymore. So the young, healthy people in this country are not obligated to carry insurance. What that means is the old people and the middle-aged people will have a much larger demand on health care without spreading it among all the population. Anyway, the Affordable Care Act participation has been abandoned completely. Now, you don't have to have medical insurance, and you won't get fined if you don't have it. The medical deduction was increased somewhat excuse me, medical deduction was decreased somewhat to 7.5% of your income. The alternative minimum tax, which affects most of my clients, but will be a while before you're affected, has been increased. And a very important provision was the doubling of the estate and gift tax exemption. As you will see, I think, in the course of the discussion today, this law, I think, does not do much for the average person in America. It is not the gigantic triumph that the administration claims it is. It is really mostly tax relief for the wealthy and especially for corporations. So there is some help for the average person in the lower rates, but we're talking about relatively small amounts of additional income, which the administration is talking about another $20 or $40 in your paycheck. But that's nothing really to what this act accomplishes in other areas. One of those areas is the exemption for gift taxes and estate tax. If your parents or grandparents make gifts to you, although there's some exception for educational institutions, but if it were just to, let's say, go on a trip to Europe, that's subject to gift tax. And there are annual exemptions that you're allowed to give without filing a gift tax return. But if you give a lot of money to somebody, you have to pay a gift tax. The exemption now has been increased to $22 million for a married couple before they have to pay any gift or estate tax. So that the effect of that is that 99.9% of the decedents dying in the United States will not have to pay any estate taxes. That's good for the family farmers and the small business people and the like, but we had a fairly high exemption before, and now there are going to be very few couples that have more than $22 million in taxable assets. And so the vast majority will not be filing an estate or a gift tax return. The charitable deduction was going to be reduced, but the colleges, universities, hospitals, Red Cross, and everybody else lobbied to a point where they said, if you take that away, people will not give money to charity anymore. I'm sure CMC would be affected too. So they not only kept the charitable deduction, they increased it to 60% of your income. So if you earn $100,000 a year, you can give $60,000 to CMC or any other public charity and take a deduction for it. So that's new and is actually an increase. On the other hand, the mortgage debt for second homes is now reduced, and what we don't have and still don't have is an exemption of the sale, the capital gain on the sale of a home. So in Northern California, and I'm sure around here as well, it is not unusual to have bought a house 40 years ago for $150,000, $200,000, or maybe a little more, and the house is now worth $5 to $10 million. Under prior law that was repealed some time ago, you could sell one house and buy another. So if you didn't want to live in San Francisco anymore, you could take the $5 or $10 million and buy a house in Bel Air or in Claremont, California. You may not find a house here for $5 to $10 million, I would think, and reinvest the money without paying tax. That is no longer the law and hasn't been, and now the only thing you can do to avoid paying tax on the sale of a house is to convert it from an individual residence into investment property. And you do that by converting the house into a rental unit. So you move out of the house, you rent it out for a few years, now it's an investment property. You can do a tax-free exchange of that property for another investment property, but you can't buy another house with it that you're going to use as a residence. Now that is about those are the salient provisions that help taxpayers. What the government giveth, it also taketh away. And there are a lot of things that are out. The most important of these to Californians and other people privileged to live in a very high tax state, and California is one of the highest in the country, is the non-deductibility of taxes in excess of $10,000. So if you buy a $5 million home in San Francisco, the property taxes would be about $60,000 a year, and your state income tax will probably be $50,000 to $100,000, and your sales tax is even more. It doesn't matter. You take all those taxes, put them together, and the maximum you can deduct is $10,000. Whatever the motivation was for that, the effect is that it hits the states where income taxes are the highest, of which California is top of the list, and New York and Massachusetts, and some of the other, Oregon. What do those states have in common? Well, they're all on the east or west coast. What does the east and west coast have in common? Well, none of them went for Donald Trump. So we consider this Trump's revenge in terms of those of us who did not support his candidacy. It's a serious increase in your taxes. In my client's case, it's enormous because they're being able to deduct, for example, California income tax. If the client pays $100,000 of tax, before he could deduct that, and so the net cost to him or her was just $50,000. Now, that money comes out of tax-paid funds. So he first has to earn $200,000, then pay the income tax on the $200,000, which is $100,000, and then on $100,000 he can pay his state income tax, which isn't deductible. So if you put those two things together, you'll see there's very little left for the wealthy taxpayer in terms of percentages of what he or she earns. Other restrictions which further limit the tax benefits, the amount of interest you can deduct on a home mortgage is now limited to $750,000 of property. That may be meaningful in Nevada or Ohio or somewhere, the flyover states, but it's not meaningful much in California. So if you live in a $5 million house, you can no longer deduct the interest except on the first $750,000. So that's another way the tax was increased. If you borrow money on your home in order to make repairs or remodel, so-called home equity debt, the statute provides the interest is no longer deductible, period, regardless of the amount. And one of the toughest provisions, and I think one of the most unfair, is that Congress has repealed any deduction for casualty or theft losses. Let me give you an illustration. California, as you know, had tremendous fires both in the north and the south. If your house burnt down and you didn't have adequate insurance, there was at least one benefit, and that is you could deduct the loss on your income tax so that you could use part of the money to buy a new house or build a new house. Now that's no longer true. So if you don't have adequate insurance and your house burns down, that's just tough. You have to pay for the new one with tax-paid dollars. There's no deduction available. The same is true if somebody steals something of value. You have a Van Gogh painting in your home, somebody steals it, it's not adequately insured, there's no deduction. So obviously the message of that is carry a lot of insurance because the government is no longer sharing your loss. And insurance may be expensive, but in this case it's certainly worthwhile. Another deduction that I'm very sorry to see go is for professional fees. So attorneys, excuse me, accounting, can I have some water? CPA fees, thank you, investment advisor fees are no longer tax deductible. Before, the test was if that individual helps you make money, then his or her fees become tax deductible. But when we solicited a client for investments, for example, we'd say our fee is 1%, but the government pays half through the tax deduction. That's no longer true. You can't deduct your accountant's efforts to make out your tax return. You can't deduct your lawyer's efforts in business unless, well, business is not a good example, in personal matters if they are just investment related. And employee business expenses, if your employer does not reimburse you for expenses incurred, you can't deduct those either. There's more. One of the deductions is they repealed the alimony deduction. I know most of you are not married, but if and when you are and the marriage doesn't work so well, if you are the money-earning spouse, you could pay the other spouse. I'm trying to be politically correct here. Let's just say the husband pays the wife. That's most of the time the case. The husband could deduct what he pays his ex-wife as alimony, and the wife had a corresponding amount of income. That worked pretty well because by definition, the husband in my example had more money. But of course, it works the other way around. And in California, we have a community property state. The wife quite often nowadays pays alimony to the husband, so she can't get a deduction anymore. She's supporting her ex-husband with tax-paid dollars, which makes it doubly painful, I would think, to send him a check, and you can't write it off. And I don't think this affects CMC, but the government imposed a tax, a new tax on educational institutions who have large endowments of 1.4%. It doesn't sound like much, but remember, most of those endowments earn between 5 and 8%. So a 1.4% tax every year, not based on the income, but on the value of the endowment, is a very substantial tax. That's the administration's help for public education. And lastly, the so-called kiddie tax has been changed to increase the rates a lot. What that is a tax, an income tax on a minor. In this country, children who earn income have to pay tax like adults. And I used to give as an example Shirley Temple, but then people in my law classes said, who the hell's Shirley Temple? And I explained, and then somebody said, oh, I remember her, she was ambassador to the UN. That was not the point of the illustration. She used to be a darling little girl who danced and sang little lollipops and so on, and she was making quite a bit of money. So the kiddie tax now is not at the parents' brackets anymore, but at the child's own bracket based on trust income. So that means on $12,500 of income, which isn't that much, the child would pay 37%. So those are all the things the government has taken away, and at least from individuals. I think it should be obvious at this point that the amount of publicity that this is an enormous tax saving for individual is at least exaggerated, if not totally false. And to illustrate the real effect of this law, we have to talk about what happened to business. The corporate income tax used to be anywhere from 15 to 35%. It goes up as you make more money. Congress has lowered that to 21%. And we're not talking about small corporations. We're talking about every corporation on the New York Stock Exchange and elsewhere. So a company like General Motors or IBM or the largest companies in America are only going to be taxed 21%, which admittedly is about what the worldwide average is for corporations, and the justification was to make them competitive to other countries. But the result is an enormous reduction in federal revenue going to business. Now, the theory was that this extra income would trickle down to the employees in the form of increased wages. And indeed, some of the companies have raised wages a little bit, and maybe they'll do so more. But the major effect is to increase the earnings of the company, and that in turn translates to the fact that the price-earnings ratios today are reasonable. That is what we use to judge whether a security is expensive or not. So a stock that was selling at 25 times earnings, now that the earnings have gone up because the taxes have gone down, the stock will only be selling at 18 times earnings, so that makes the stock market much more interesting. There are various other things because of time limitations affecting business that I could talk about. Most of them have to do with the things that affect individuals. They now limit meals, entertainment deductions. If you take an individual out for lunch or an expensive party or something, you can't deduct that anymore. There are limitations on commuting expenses and on other things that you might normally have deducted. They did increase the amount of depreciation on new cars to $10,000 the first year, and then it goes down every year after that. And a very important provision is the repatriation of money stashed abroad. You may remember that Apple and many other corporations had literally billions of dollars in foreign countries that had never come to the United States and had never been taxed here. So Congress imposed a 8 to 15% tax on that money, and Apple has in fact repatriated several $100 billion of money from foreign countries into the United States, and hopefully is using that money to hire additional people or do additional research and the like. And other corporations are doing that too. That's a very pro-business deduction that might actually benefit the average person. Most of the rest of the tax law has remained the same, and because of time limitations, I can't really talk about it. But one provision they did not enact, which would have been very serious, is so-called FIFO Accounting. We have a professor of accounting here who it's been my pleasure to meet. We didn't talk about inventory valuation, which would have been fascinating, Professor. But basically, this isn't as dull as it sounds. Let's say that you bought a stock like Apple every single year, and you bought it when it first came out and became public, and every year thereafter. So you bought it at $10, $20, $30, $40, $50. What the law that was proposed by, and passed by the House of Representatives said is that when you sell a share of your Apple stock, it will be identified as the one you bought first. FIFO is not the name of a dog. It is first in, first out. So if you sell a share that you bought last year, you're not allowed to identify that. You've got to identify it as the $10 stock you bought 25 years ago. That would really be a harsh provision and would, in my judgment, really affect the marketability. The Senate, in the last minute, took that out, and now you're allowed to designate. So if you sell 100 shares of your Apple stock, you can say, this is the stock I bought a year and a half ago. Remember, it has to be more than a year and a day old in order to qualify for long-term capital gain. I also want to take a few minutes of my original topic, which I had offered to talk about, just to mention a few tax mistakes that people make that you may have an occasion to tell somebody in your family at some point. The biggest mistake I can think of is the following. In one case in my office, an individual who was terminally ill, about 5 days before he died, gave all his property away, including a house that he bought 50 years ago in San Francisco for, let's say, $100,000. It was less than that, and which is now worth $5 million. And by doing so, he passed up the so-called stepped-up basis that occurs when somebody dies. What that means is that when somebody dies, his or her assets are stepped up in value to the value on the date of death. So to illustrate, if he had kept that house a few more days and left it to his children, by will, the house would have had a $5 million tax cost instead of a $100,000 cost. So what he gave away was his house and $1.5 million tax liability to his children. So assets which have highly appreciated should not be given away by the donor during his or her lifetime. They should pass through his estate. And in California, we have a special provision which applies only in community property states. It's section 1014B6 of the Internal Revenue Code, which thankfully made it through the revision. And it says that all of the assets held in community property, which is everything a husband and wife make and earn after they get married, has a new basis. So that allows the heir, typically the widow, she usually survives, to sell everything at fair market value and pay no capital gains tax. Let me give you an illustration. Say that you're Mrs. Bill Gates, and your husband has $1 billion worth of Microsoft stock. If he dies and leaves it to her, she has a stepped-up basis, meaning her basis goes from the zero that Bill Gates had to the $1 billion that it was worth on the date of his death. She can sell that stock for $1 billion and pay no capital gains tax. And not only that, there's no estate tax either on the $1 billion, because the marital deduction provision of the will allows all the assets that the one deceased spouse leaves to the other to be tax-free. So Mrs. Gates ends up with $1 billion of stock with $1 billion tax cost, which can sell for no income tax, and there's no estate tax until she dies, unless, of course, she remarries, which with $1 billion is a possibility, and leaves it to her next husband, in which case this thing gets another generation of tax exemption. So giving away things in your lifetime, what should you have your parents and grandparents give you? The best thing is cash, because there's no inherent gain in that. Stock is less desirable to the extent that it has appreciated, because you're giving away a capital gains responsibility at some point when you sell that stock. And then the more appreciation there has been in that asset, the less likely it is that it is suitable for lifetime gifts. Another example that I just want to mention is the gift of tangible personal property. What is that? You have two kinds of tangible property that you can touch and feel. One is real estate, and the other one is personal property. The tax law provides that if you give personal property to a charity, you can't get a deduction for the value of that property no matter how long you've held it, unless the property being given is used in the charity's exemption. That sounds very technical, but let me give you an example. Say your parents or grandparents have a high-value painting, an undiscovered Van Gogh, and it's worth $1 million. Giving it to, let's say, the SPCA would not get you a $1 million deduction. All you can deduct is what they paid for it, which might have been a very small amount. The property has to be related. So one of my students said, what if the painting was of a horse and you gave it to the SPCA? And I said, that might be something a tax lawyer could argue. But for example, for years we had KQEDs, our public broadcasting station in San Francisco. They used to give a wine auction on television where you could buy wine, and they advertised this is a way for the donor to thin his cellar and get a big tax deduction too. So that isn't correct, because the wine being sold is being bought by people who are going to drink it. It's not going to be somebody who's using it in his charity. So I pointed out to them some time ago that they were misleading the public in terms of their statement that it was tax deductible, and I'm afraid that resulted in the end of the wine auction. But that is the law, and I don't think a public station should be advertising things that are incorrect under the tax law or otherwise. I've rushed through this. Let me just close by saying that this tax law is going to create an enormous deficit every year. The estimate is that in 10 years, the deficit will be $1 trillion. That, for those of you who are not math majors, is 1,000 billion, or 1,000,000 million. That's the deficit. That's the difference between what the government takes in and what it pays out. We can't possibly function in that basis. Either taxes have to be increased, or the benefits like Social Security and Medicare have to be reduced, or something has to be done. Maybe the government have a big lottery of something and raise some money. But it is very serious stuff that we haven't had a balanced budget since President Clinton, and I don't see how we'll ever have a balanced budget if these tax laws continue. The good news is that the individual tax cuts have only a finite life. They end on 2025. The corporate tax cuts, however, which are the big loss of revenue, Congress made permanent. And I was suggested that if we get a Democratic Congress this fall, we may repeal these, but of course the president would veto that repeal, so we're stuck with this now indefinitely. Thank you for your attention. I'm supposed to allow some Q&A time. Do you want to come up here, or? Okay, I still have pretty good here. I'm sorry, I'm losing the last. Do I recommend what?
Yeah, lobbying business or public bureau business, such as let's say if I want to sell Lockheed Martin or Raytheon or Northrop Grumman to East Asia, in that case, do you recommend just work as a sole yeah, that one, just like, yeah, that one, or do you recommend me to set up the company in Delaware that I can, excuse from the state tax, or even in Virgin Island to like state haven? So which way do you think, which way is the most like savvy way that I can waive?
Okay. Well, answering your question, I can just do it in generalities, because if I were planning your taxes, I would want a lot more knowledge about how profitable you're going to be and what tax bracket you're in. But first of all, taking the end question first, moving to the Virgin Island does exactly nothing for you. The U.S. law is very simple. It says an American, I don't know if you're an American citizen, but if you are an American citizen, it doesn't matter where you live and what you earn, the source of your income, or anything else. You can move to Afghanistan and never come back here. You'll still be taxed in the United States until you give up your citizenship. And even that isn't enough. There's a federal statute that says if you gave up your citizenship for the purpose of avoiding or evading U.S. taxes, you still get taxed in the United States for another 10 years. So that takes care of the Virgin Islands. Oh, although they may be part of the U.S., then I don't really understand what moving there would do. But whether you should incorporate, my general answer is you don't need to. Sole proprietorships, I didn't mention this, but sole proprietorships get a 20% deduction on their income under the new law, regardless of any other deductions they have. So being a sole proprietor works out just fine. Okay?
I'm sorry, that's why I'm just stick to my green card situation. So, one more question. So in that case, like let's say if I get the money under the table, what's the difference? What's the like difference between the like cash itself or like gift itself, or what's the difference between the bribe itself and gift? Because it's kind of hard to tell. Because under the California law, if I think like $50 is the maximum that I can give the present to the professors, but yeah, if I get that, I'm not really happy with the like. I just want to give them like some kind of biryani like ties or ketan ties. In that case, how do I have to?
Okay, giving individual advice is very difficult in a group, because it's like giving medical advice and you tell me you have a pain here and what do I think? And I'll opine on that too, but I really would have to examine you first. Having a green card makes you taxable like an American. Getting paid under the table and not reporting it as a felony, and you will go to prison with other Americans and green card holders. Okay, other questions? I think you need the mic.
I know you're a tax attorney and you're very, very good in your area. I'm going to ask you to be a little bit of an economic predictor. A lot of big corporations are going to have a lot of money, and one hopes that a lot of that money would go to increased
Would go to what?
Would go to increased wages or salaries for their
Yeah.
workers. One suspects that a lot of it is just going to go to buying their own shares and driving up the price of
Yeah.
them. Do you care to make any comment on that?
My comment is I totally agree with you. The so-called trickle-down theory of economics was already tried twice before, I think most recently by Ronald Reagan. And the idea is that if you make the corporations and the employers very wealthy, a certain amount will trickle down to the workers, and probably some amount will, but it certainly isn't dollar for dollar, and I absolutely agree. The corporations will use this money to increase dividends. That's not necessarily their workers, and their stock buybacks. That'll help their stock price. So the way to profit from this probably is to get more stock in your 401k, pension plan, KEO, or IRA, and not buy bonds, which are historically very expensive and will clearly go down in value as the Fed raises interest rates. There's a question over here. Yeah, go ahead.
Thank you for your time. I'm just curious if the new legislation has addressed favorable treatment of pass-through income, such as carried interest.
There are two aspects of the new law that deal with pass-through income. The first is the 20% reduction in income for partnerships, limited liability companies, S corporations, the ones that are taxed like individuals or partnerships. And what was the second part of your question?
How it deals with
Carried interest. The carried interest is a gigantic loophole that allows the hedge fund managers and others, but mostly hedge fund managers, who make, in some cases, hundreds of millions of dollars a year, to treat that money as a capital gain rather than as ordinary income. Congress considered that, but for some reason they decided to leave that alone. You can figure out why, probably.
Trickle-down economics, if it's going to be restricted, what in our deficits increase? What's the prognosis, say 5 years from now and maybe 10 years from now? Because it seems like if we're not going to have a balanced budget, we're going to go bankrupt.
Well, we haven't had a balanced budget most of our existence in modern times. I don't remember whether Jimmy Carter had one or not, but I know he didn't. I think that we've only had one president administration that had a balanced budget, and it didn't have enormous enormous profits. So what we do is we borrow the money, primarily from China, which has the most favorable balance of trade with us, and we just keep printing money. And what that results in is inflation, which in turn results in the Federal Reserve's raising interest rates, which increases but slows down inflation. And I don't know, you're suggesting that trickle-down may not work at that point. That may well be the case, but in my personal opinion, it doesn't work to start with. It's been proven that if you double a wealthy person's income, the people he employs, let's say the maid or the chauffeur or the clerk in the office, their incomes don't double. They may not go up at all or insignificantly. So I think trickle-down economics doesn't work. It has been disproven twice. And one definition of insanity is doing the same thing over and over again and expecting a different result. Does that answer you?
Yeah, almost.
Almost.
So 10 years from now, what's life going to be like if our deficits just keep skyrocketing? Does it ever work out for us?
Well, predicting the future is always difficult. I would say this is a problem the United States will have to address. It is very serious. If we have a $1 trillion deficit, the money will rapidly lose its purchasing power. My ancestors in Germany lived through an inflation period where people wouldn't take currency anymore because you had to give thousands of marks to buy a loaf of bread. And the way they survived is they were in the wine business, so they swapped wine for bread and wine for meat and wine for medical services. If you didn't have anything to swap, you were in trouble. We cannot allow inflation to go that much out of hand, but that's going to be the inevitable result unless they do something to change the law. One thing they could do is impose a new tax called a value-added tax, which is all over Europe. And that's one you can't evade, even under the table. That simply is a national sales tax. So every time you buy something that isn't exempt, like a car, in addition to the local sales tax, there'll be a federal tax. That might do the trick. But those taxes, like sales taxes, are very regressive, meaning that the poor pay a much higher percentage of them than the rich do. The rich may buy a car once in a while, but by and large, they don't spend that much money. The poor have to spend every penny that they earn, and if there's a tax on everything they spend, that's an indirect, very heavy tax on the poor people. This law, as I indicated, is not a godsend for the middle-income people. The poor were given something. They have a $2,000 per child credit. That's to allow you to support your child for a year. If you can tell me how to support a child on $2,000, I'd love to hear from you, because it's impossible. The food alone would cost that, the housing, the school, the medical deductions, and so on. So that was about, and even that was only put in at the last minute. The senator from Florida insisted on it, or he wouldn't vote for the law. The one, what's his name? Rubio, one who ran for president. So this country's going to be in a lot of trouble, but nobody seems to care. And it's a little bit like Saturday night, and you drink all you want, and you worry about the headache tomorrow morning. Yes, sir.
Thank you so much for coming back to CMC and taking the time to talk with us.
You're
about
welcome.
this
I love it.
topic. Great. So I may have missed this in the beginning of your talk, but what deductions for corporations or businesses were added or taken away with the new tax law, and how will this affect government revenues?
Okay. I didn't talk about business deductions at the beginning, so you didn't miss anything in that regard. The major thing that Congress gave them was this 20% exemption for so-called pass-through entities, which are like partnerships, sole proprietorships, and what are called S corporations, the ones that elect to be taxed like a partnership. That's the principal thing. They cut back some deductions. I talked about meals and entertainment and the like. And they also said that salaries have to be reasonable, but that's been in the law all along. They put it into the new statute again. I don't know what that adds. Other than that, the biggest thing they did for business was cut their taxes to 21%. Jamie Dimon, the chairman of Morgan Stanley, said the other day their earnings would probably go up by more than $100 million as a result of the tax. He didn't say that we'll give those to the employees. Yes, sir.
So it doesn't sound like you're a big fan of the reform. If you were devising tax policy, at the federal level, what would you do?
You're right about my attitude. I think that the administration is, to put it mildly, exaggerating what they've done for the average person. Tax policy, I think that I believe in progressive taxation. You've got to tax the people who have the money. You can't tax poor people because they don't have the money to give you. And ours is relatively, well, it's partially progressive, but when it was very progressive, as you know, the rates went up to 91%, but people who were in that bracket had all kinds of tax shelters, so they never paid the tax. And as a practicing tax lawyer, part of our business was putting them into these shelters, because by the time you tax federal tax 91% and a state tax of 10, it doesn't leave much. You actually lose money by working. So nobody paid those rates. And probably a value-added tax with an exemption for poor people in some way, let's say by exempting food, for example, or rent under $1,000. You could figure out ways to take care of the poor part of our population so they wouldn't have to pay that. In California, for example, there's no sales tax on prescription medicines, but there is on the other stuff you buy in the drugstore. That's about all I can think of.
Go ahead.
Pardon?
Unfortunately, we are out of time
Okay.
today. So I would like again to give a big round of applause for Peter Maier and thank him for coming out to the act today.
I just want to add that it's been wonderful being here. The place has changed a little in this last 70 years. When I went here, we had 2 dorms, which are still up. Green was one of them, which I lived in. And the rest were Quonset huts. And if you know what that is or don't, these were World II temporary fabricated buildings which were designed to be knocked down as soon as a permanent building went up. So I don't really recognize the campus. Thank you.